My investment strategy to constantly outperform the stock market is twofold. Either I buy large cap, reputable companies like AMD at $100 a share, Uber at $67 a share, or Google at $153 a share, or I buy young, multi-year compounders like SoFi at $11 a share, Sezzle at $35 a share, or Hims and Hers at $14 a share. And the stock I'm going to be discussing today fits into the second strategy, where this stock could literally do anywhere between a 3x to a 7x over the next 5 years, or it can crash and burn and go to zero. And that stock is AST SpaceMobile, ticker symbol ASTS. And full disclosure, I'm not an expert in this industry, but this stock and the industry as a whole really caught my attention. And if I'm being honest, when I first heard about ASTS, I just thought it was some sort of space exploration stock and I completely disregarded it because it's a pre-revenue company. But when I look deeper, I really do think the stock has massive potential if and only if management is able to execute. So to put it very simply, what ASTS really does is they're building the first and only space-based cellular broadband network. Now this sounds a lot like what Starlink is trying to do. So I really did do a deep dive on the differences between Starlink and ASTS, and these are the main differences that I was able to find. So the first major difference is that ASTS needs no hardware at all. As opposed to Starlink, where you need a dish and you need a router, ASTS, all you need is a phone and you can connect straight to the internet. This is the first very big difference. The second difference is that Starlink is actually a direct-to-consumer model, where they don't partner with anyone. You just go on the Starlink app or the Starlink website and you can purchase the plans from there. But with AST SpaceMobile or ASTS, they're planning to partner with carriers like AT&T, Verizon, Vodafone, etc., etc., etc. And as far as the speed, Starlink is much more designed for faster internet speed, like streaming, gaming, and full-on broadband, as opposed to ASTS, where it's more for calls, texts, and basic data as of now. And so to kind of sum it up, the main value proposition for ASTS over Starlink is that you don't need any hardware at all. That's really the main selling point. And this is how they plan for it to work once it reaches scale. So let's say you're with Verizon, for example, or AT&T, and you go to a place where there isn't proper coverage. You get a text like this saying, "Do you want to turn on your SpaceMobile Day Pass?" And then you say yes or no, and you pay like $10, $20, whatever it's going to cost. So this is how they expect to start rolling it out at first. And then eventually they're going to start selling obviously monthly subscriptions, yearly subscriptions, etc., etc. And so ASTS plan to deploy nationwide service in the United States by the end of 2025, followed by the UK, Japan, and Canada in Q1 of 2026. So, they're really getting the ball rolling, and according to them, they plan to start having their services rolled out at the end of this year in the United States, and next year, early 2026, so Q1, Q2, in the UK, Japan, and Canada. And they're anticipating at least 5 orbital launches by the end of Q1 2026, with orbital launches every 1 to 2 months on average to reach the goal of 45 to 60 satellites launched during 2025 and 2026. And so these satellites and these orbital launches that they're doing, they are what the infrastructure that is needed to provide this internet. So instead of right now, how when you drive on the road, you see all these huge network towers, the telecom towers, these satellites are going to be replacing that. And so what they need to do is they actually need to send these satellites into outer space. And we'll talk a bit more about that. But before we do that, I want to talk about just how big this industry is and why I think a company like ASTS has massive potential if management is able to execute. Because the global telecom industry is already a $1.1 trillion industry globally. So just think of how big this industry is. And in 2024 or in 2025, there are approximately 5 billion smartphone users worldwide. So there are 5 billion people who have smartphones who need access to the internet. And the global telecom industry is a $1.1 trillion industry. So this just goes to show just how big of a total addressable market a company like ASTS has. And now we're going to talk about some of the reasons why I think ASTS actually has a good chance of being successful, like why I think they can actually win out when it comes to this market and this industry. So the first thing I want to talk about is that they've already launched 5 successful commercial satellites as of September 2024. So number one, so this is the very first reason, is that they've already tried this and they've already done it successfully. And this just goes to show that they do have the capability to launch these satellites into lower Earth's orbit. The second reason I want to talk about and why I think ASTS is special is that they're 95% vertically integrated. And that means they basically own the entirety of the manufacturing process. And they have 2 sites in Texas. And it says here 95% vertically integrated manufacturing with content manufactured in-house or through third parties using intellectual property, driving speed, certainty, lower costs, flexibility, and reliability. I mean, it goes without saying that a company that's vertically integrated has tons of advantages. And they talk about some of these advantages here, like lower cost, reliability, and flexibility. The third reason I want to talk about, which is probably the most important reason and the most important reason why I think a company like ASTS has a real chance of being successful in this industry. And that's the fact that it has these super important partnerships all around the world. So they have 50 MNO partners that have 3 billion subscribers globally. So these 50 partners have access to 3 billion subscribers globally. And some of these partners include companies like AT&T and Verizon, which are the biggest telecom providers in the United States. They also have Vodafone, which is Europe's version basically of a Verizon. They also have Bell, which is Canada's version of a Verizon. They also have Rakuten, which part of it is Japan's version of Verizon. They also have companies like Africell, which I'm assuming is like the Africa version of Verizon and TNT. They also have Zain and STC, which Etisalat, which are the Middle East's version of Verizon and AT&T. So essentially what I'm trying to show you is that they already have these partnerships in place to like massively scale this product once it's ready to be used for commercial reasons. And not only do they have some of the most important partnerships in the world, but some of these companies are actually investors in ASTS. So one of the biggest investors they have is Rakuten, which is the conglomerate in Japan that has their own version of Verizon and AT&T. They also have Alphabet Inc., which is Google, one of the most important companies in the entire world. AT&T is also a strategic investor, and this is super important for obvious reasons because AT&T is going to be one of those partners that spreads ASTS's products once they're ready for commercial use. And they also have Vodafone, which I talked about as the Verizon and the AT&T of Europe. And they also have American Tower Corporation, which, if you don't know, this is the company that sets up most of the telecom towers around the United States. Like when you're driving on the road, those telecom towers you see, most of them are set up by this company. And so, if you can't beat them, join them. And instead of trying to compete with the ASTS, they're just buying a stake because they really do, just like I do, they see the potential of this company. And so those are just some of the reasons why I think ASTS has a real shot at actually being successful when it comes to this industry as a whole. And now let's talk about some numbers. So the first thing I want to talk about is how costly it is to send out these satellites into space. So according to ASTS, non-continuous connectivity services could start in the US with just 25 Bluebirds, while 45 to 60 satellites would be needed for continuous coverage across the US, Europe, and Japan. So for services in the US, they're going to need around 25 Bluebirds or 25 satellites. But to get coverage in the US, Europe, and Japan, so basically to get connectivity services in the US, they're going to need around 25 Bluebirds or 25 satellites. But to get coverage across the US, Europe, and Japan, they're going to need around 45 to 60 satellites. And in terms of how much these satellites or these Bluebirds cost to build and to send into outer space, it says here, higher direct material costs impacted by recently imposed tariffs have also inflated the estimated average cost for a constellation, increasing to $21 million to $23 million per satellite from the prior estimate of 19 to 21. So once again, it costs them around, let's say on the higher end, $23 million per satellite, and they're going to need on the higher end, once again, 60 satellites to get coverage in the US, Europe, and Japan, which are their 3 biggest markets. And so if you multiply 60 satellites by $23 million per satellite, you get around $1.2 to $1.3 billion. And that's how much it'll cost for them to have full coverage in the US, Europe, and Japan. And the good news is that they already have $900 million in cash. So they only need to raise around $300 million more in order to hit their goals of reaching 60 satellites, which once again would give them service coverage in US, Europe, and Japan. So they only need to raise another $300 million more, and they're probably going to do that through more share dilution, which they've already done a ton of. But the good news is that we can expect their share dilution to kind of slow down now that they basically have all the cash, or they almost have all the cash they need in order to build and launch these 60 satellites. And so the next thing I want to talk about is probably the most interesting part of this thesis, which is the valuation. And if you can see here, this is their price to sales. Yes, and it does say 1,244. And for any value investors, I know this is probably the most insane thing you've ever seen. And listen, like even to me, I don't invest in a lot of these companies that are like pre-revenue or trading at like crazy price to sales. And the forward price to sales is better. It's a lot better, but it's still 88 times forward price to sales is not something I've ever paid for any stock in my portfolio. But this is not one of those companies where you can value it according to its current price to sales. This is a pre-revenue company, basically. They have like barely any revenue as of today. And so you don't value this company according to what its revenue is this year or even next year or even the year after that. You really need to sit down and look at how much potential revenue this company can have over the next 5 years. And this is kind of what venture capital firms that invest in pre-revenue companies do. They don't value them on a PE basis or a price to sales basis. They have to kind of project according to their network, according to their total addressable market, how much revenue they think they can get over, let's say, the next 5, 6, 7 years. And so I did my own assumptions and my own estimates, but instead of using that, because my estimates were a bit too aggressive, I went and found estimates that Deutsche Bank did. So Deutsche Bank did a full in-depth analysis of what they think ASTS can do over the next 5 years. And the two most important line items from this picture is the total revenue right here and the free cash flow. And what we're going to see here is that by 2030, Deutsche Bank is expecting closer to 5.1, but let's just say $5 billion in revenue by 2030. And again, right now, this company has 60, 50, 60, 70, something like that, $1 million worth of revenue. So they're basically expecting the company to 100x in terms of revenue. Okay, so I need you to keep that in mind. So these are very aggressive assumptions, but this is what they think they can do according to the networks they have and according to the total addressable market they have. And they're expecting, out of this $5 billion, they're expecting $3.4 billion in free cash flow. And so this means if you're doing 5 billion in revenue and 3.4 in free cash flow, you're basically assuming that this company will have 70% free cash flow margins, which, if I'm not mistaken, is probably one of the highest in the entirety of the stock market. Like there are not many companies at all, if any, that have 70% free cash flow margins. And this is largely because once this company has all of these satellites set up, there's really no more costs to the business, right? Because they just collect subscription revenues. And there is no like advertising costs because they're going to be making all their money through their channel partners, again, like AT&T, Verizon, Vodafone, et cetera, et cetera, et cetera. So once again, $5 billion in revenue by 2030 and $3.4 billion in free cash flow by 2030. And if I have two case scenarios here, and I have to preface this, when I say base case scenario, this assumes that ASTS becomes successful and actually does what they set out to do. Because like if I'm being totally honest, the worst case scenario for a company like this is that it goes to zero. Because as of today, as of right now, they really haven't proven much. They don't have a lot of revenue. They only have a few satellites that are launched into outer space. And so as of today, they really don't have much to show. So in reality, the worst case scenario is that a company like this goes down 70, 80%, or maybe even goes bankrupt. Okay, so I need to preface this by saying, and when I say base case scenario, I'm assuming that this is the base case scenario if they hit their goals of reaching $5 billion by 2030, which are already very aggressive goals. And again, this is a 100x in revenue. So this isn't like a base case scenario where I'm like, it's like a company like Google, I'm expecting their base case scenario to hit 10% EPS growth per year. This is totally different. This is assuming they hit all of their goals, and their goals are, $5 billion in revenue. So if they do hit $5 billion in revenue by 2030, I'm going to give them a price to sales of 10 times in 2030. And I'll explain to you why I think 10 times is actually, super cheap if the company does hit these assumptions. So 10 times price to sales gives them a market cap of $50 billion by 2030, right? So 5 times 10, 50 billion. And so right now, today, they're trading at around $14 billion in market cap. So that would represent a 28% returns per year from now until 2030, which is extremely solid. Now, my best case scenario, I'm using similar numbers, so $5 billion in revenue, but instead of 10 times price to sale, I'm using 20 times price to sale. Now, you might be thinking that this is insane, but I'll give it to you in other words. So instead of using the price to sale, let's just use price to free cash flow. And once again, they have right over here, they have $3.4 billion or they're expecting to have $3.4 billion in free cash flow by 2030. And this would mean that they're growing free cash flow. Right under it here, you see 31% per year over year. So from 2029 to 2030, they're expecting, or analysts are expecting, that they're going to grow their free cash flow by 30% year over year. And so I think for 30% growth, I think 30 times price to free cash flow is very fair for a company like ASTS. And if I do give it a 30 times price to free cash flow, so 30 times 3.4 billion, you get $102 billion in market cap by 2030, which would essentially represent 49% returns per year from now until 2030. And I know this probably sounds insane, like, and if you know me, you know I'm a value investor. Even though I do invest in high growth stocks, like I showed you at the beginning, like Sezzle and HIMS, I'm not usually investing in companies that are pre-revenue and burning tons of money. I'm usually looking for profitable companies that are compounding year over year. But this is one of those few times where I think this is actually a super interesting bet on the future of, let's call it, the internet. Because, you know, although the worst case scenario is that this company goes to zero, the way I'm protecting myself, and full disclosure, I don't have a position in ASTS yet, but if I do decide to take on a position, it would probably be a very small part of my portfolio, maybe 2, 3, 4% at the very most, because even though this company can go to zero, the upside is enormous. And we're seeing here that according to these assumptions, the base case is 28% returns per year from now until 2030. And the very best case scenario is around 50% returns per year from now until 2030. So only a small amount of my portfolio would be sufficient if this thesis, you know, eventually does end up playing out. I don't need to have a big position in this. I only need to have a very small position for it to produce massive amounts of gains for my portfolio. So I hope you guys enjoyed this video. If you have any questions, make sure to drop me a comment down below. And if you find value, make sure to leave a like and subscribe. Peace.